Well, hello everyone. Welcome to Getting Started with Technical Analysis. Today we're talking trend. And with what's been going on in the world and in the markets, I thought this would be a good day to talk about how to spot changes in trend, or how not to react with a knee-jerk reaction to pullbacks in the market, which may or may not be temporary. So today we're going to look at trend. It is the second in our class in our 9-week rotation. My name is Barbara Armstrong. I'm a coach with Schwab. Delighted to be with you today. If you are not following me on X, consider this your formal invitation to do so. My handle at Barbara Armstrong CS. We also have Scott Thompson with us in the chat. He is a friend, a fellow coach, and manager actually in the coaching group, and he is with us riding shotgun in the chat today. So if you have any questions, please don't hesitate to ask. You'll want to follow Scott on X also, Scott Thompson CS. So be there, be square. So just before we get into kind of the thick of things, know that everything that we cover in this class is for general information purposes only, none of it to be construed as a recommendation or as personal investment advice. If we discuss options, know that those carry a high level of risk and aren't suitable for all investors. We use the Paper Money platform on the Thinkorswim desktop, and it is a brilliant place to learn. And there are some nuances and differences between Paper Money and a live account, and we'll discuss those as we go along. When we use stop loss orders, which we often do in this class, know that they are not a guarantee that you'll get out at the requested price. If a stock were to gap down, you could be out at a lower price. So, this is our 9-week rotation. And on occasion, when I have people filling in for me, we may have a bonus session. And then usually at the end, we'll throw in a bonus session or two. Last week, Rachel was filling in for me, and she talked about relative strength and how one can use it to, look for changes in momentum. So if you missed that, you may want to go back and check that out. And so today our focus is on trend. And so we're going to review some of the basics, look at some basics on trends, look at moving averages, and we're going to actually spend most of our time today looking at charts. Okay. And just, as we get going, I just want to welcome all of you and thank you guys for helping bring this class to life by being so interactive in the chat. It's good to see both new faces. Lewis is here after a 3-year hiatus, so welcome back to Lewis. And then we've got Sandeep and Paul and Roger and Stoic-ish. Like, I love some of these handles, and Richard and Lena, and her name was Lola, and Marcus and Will and Sharon and Sandeep and the rest of the gang, Ricebird. So it's great to have you guys all on board. So having said that, price can move in 3 different ways, right? It can move up, it can move down, and it can move sideways. And price is considered to be a reflection or a representation of everything currently known in the market. And so, this is why insider trading is illegal, because it isn't information that is currently, current collective market knowledge. It's something that only a few might know. But this is, what price is a reflection of. And they say that history repeats itself, and they may say, well, it doesn't exactly repeat itself, but it rhymes. And the reason for that is because it's human beings and their interactions that move the market. And human beings haven't changed all that much in the last 100 years, in that we tend to react similarly in similar situations. And, trends, if you had to take economics, which I certainly I think have a minor in economics. Yeah, but changes in supply and demand, supply being the number of shares available, in other words, how many people want to sell their shares, that creates supply. And demand is the number of people that want to buy. So supply and demand, sellers and buyers. And when you have a whole lot of sellers, what happens? We can end up with the price dropping if there are more sellers than buyers. And then it drives the price up when we have a lot of buyers and not so many people wanting to sell. Yeah. Yeah. And, so this is our uptrend and downtrend. When we have strong demand that exceeds, so the number of buyers exceeds the number of sellers, price goes up. Okay. And the same thing in reverse. So, when we have what we call a rally, we see, the buyers coming in and driving the price up. And equilibrium is when the stock, movement, that uptrend slows or stops temporarily, is all of a sudden supply meets demand, and then price can sometimes pull back. Okay. And with a pullback, we call that a retracement. And sometimes, and we talk about all these different patterns within this class. Oops, sorry, I was posting something on X earlier. But if we see a line move like this, that's creating what we call a bull flag pattern. You see, here's the flagpole, and here's our flag. And from a technical perspective, it's considered an entry when we end up with and let me just change my color here, a close. Oh, I thought I was changing the color. Let me try again. A close above the high of the low day. Now, this is just one, potential entry. And there is a swing trading class. Actually, I believe it's taught right after this one. So, when we have, here's our low day, and when we have a close above the high of the low day, which would have been this day, that would be considered an entry. And had one entered there with this theoretical chart, that would have worked out nicely, wouldn't it? And then we see another flag setting up. So when stuff goes, when stocks are uptrending, it doesn't mean that they never have a down day. We see lots of red candles interspersed here, even though it is an uptrend. Okay. Okay, so and how do we define an uptrend? Well, it is a series of higher highs and higher lows. And so we can see here, we've got a high here, higher high, and a higher high. And then on the low side, we had a low here, higher low, higher low. So if we're drawing a line through this, we can see that it is uptrending. It is going from the lower left and up to the right. And it's, when does the trend end, which is a great question. And some people are asking that question today. It's considered broken when the price dips below the prior low. So, if this next low, here's our low here, was below this, then that would be considered to be a break-in trend. But on this example chart, we haven't seen that. Okay. How about a downtrend? Well, it's the opposite. So we call this bearish, an uptrend we call bullish. And here we're seeing lower highs and lower lows, aren't we? People think of bearish as being red. So here we see a series of lower highs and then again lower lows. And if we're drawing a line through that, what does that look like? Well, it's going down as we head to the right. And I find that drawing lines or adding trend lines can be really helpful. It just helps lead the eye. And so when I'm looking at a trend and sometimes you're going, how does that really look? I find that sometimes drawing those lines on the chart can be helpful. And then what about this? And when I look at something like this, at first I think, well, that is just a hot mess. Has anybody else looked at a chart and said, like, that looks a bit like a dog's breakfast? But here, when we actually look at it, what we're seeing is a series of similar lows. And although it's not exact, like a series of similar highs. So that if we draw a line here, it seems to be trading in a bit of a range, doesn't it? And sometimes the range can be narrow, and sometimes it can be quite wide. Yeah. So it's, and when is this considered broken? When the price either breaks above the recent high, or breaks above this, we call this a resistance line, or breaks below the support line. So when it either, breaks out to the upside or to the downside. So it breaks out above, when it breaks out of the range or below the lows. And so, is there a way to benefit from a stock going sideways? Well, yeah, so some people might just say, well, I've noticed that this is going sideways. So what I'm going to do is when it gets here and bounces, I'm going to buy the stock when it bounces. Oops. I'm going to buy the stock when it bounces here. That's what I'm going to get in. And then when it comes up and it turns around, starts to turn around, then I'm going to sell it. And then I'm going to buy it again when it comes down here and bounces. And then I'm going to sell it when it gets up here and starts to turn around. So when it got here and started to pull back, you might sell it again and then buy and then sell. So this is not a long-term love affair, but what if you already owned the stock? What if you said, okay, well, buy and sell? Like I inherited some shares from my grandma. And so I already own this stock and now it's just playing with my emotions. Well, what some might do is say, okay, well, remember, it's kind of going sideways here. And let's say this is at 100. This price is at 100. So when it comes and bounces here, you might say, okay, I'm going to sell a call at 105. And then when it comes back down, when it turns around, I'm going to buy it back. And here's our line here. And then here, it came up here. When it turned around, you might see, it might turn around and bounce. But when it broke below here, you might say, okay, I'm going to sell another one here, up around that 105. And I'll buy it back when it comes down here and bounces. And then when it comes back up again, I'll do the same thing again. So we could sell covered calls. Now, Chris, has said, well, what about, iron condors? So an iron condor is a credit, like what I think of as a credit spread sandwich. So yeah, we could do that too. And this is selling a short put vertical below where we think it will trade. Because we think it's, above, yeah, we're selling below here, and then we're doing a short call vertical up here. And so what some people will do with these is they will leg in. So when it comes down and bounces here, they'll put this piece on, and then when it comes up here, they'll add this piece. Or they may wait till it's in the middle and then put it on. And the other thing that some people will do is they'll just put this trade on when it bounces, and they close it out when it gets up here. And then they'll put this trade on when it rolls over and close it out when it gets down here. So there's lots of things you can do. But today, really, our focus is on looking for these patterns and recognizing them. Somebody saying that Allstate is looking like that. There's a few stocks that have been going sideways. Some might argue that NVIDIA's been going sideways, and we'll look at some charts in just a minute. So, our trend identification, when we add a simple moving average, and today we're going to look at a chart that has a 30-day moving average and a 100-day moving average on it. But, this just helps us smooth out our price line. And so we can see that this is in the intermediate term uptrending, even though there are some short periods of time where this has pulled back here and here and here. But overall, we're seeing higher lows and higher highs, right? So it's still overall an uptrend. So the slower moving average, versus a faster moving average, what do we mean by that? Well, a 10-day moving average is going to move up and down more, and a slower moving average, like a 100-day moving average, that's accumulation of 100 days worth of information, so it's going to take longer to move. So that's what we mean by faster and slower. And many people that trade or invest on a regular basis will have more than one moving average on their chart. Yours truly is one of those. So we can look at trends with a long-term view, so looking at longer than a year. We can look at intermediate trends, which are 3 months to a year, and then short-term, which is less than 3 months. So, and which one is best to look at? Well, often, even if you are looking to trade in a shorter or intermediate term time frame, it's a good thing to have look at the longer term trend to see, is this a long-term uptrend, or has this been downtrending, and is it just kind of coming around the block? So, but it's important to analyze the trend within the time frame that matches your trading objective. So if you are looking to do a short-term income generating trade, looking at a 5-year, weekly chart is probably not going to best serve you. You might want to look at a 6-month chart or a 9-month chart. So, you want to trade with the trend that matches our objective. Okay. But then look at, take a step back before you step forward and look at a longer trend as well. Okay. Yeah. Like Chris is saying, the trend is your friend until it isn't, or until it ends. And so let's come out and look at a few things. And, Chicken Little may not be out running laps, but, she's in the barn getting ready from the sounds of things these days. So let's start with the SPX. So when we look at the SPX, like today, a lot of people have their knickers in a twist. And why is that? Well, the market's down almost 2%. So that's not nothing, right? But, and this red line here is a 30-day moving average, and the black line is 100. Now, how do we know that? Well, if we look up here, it says simple moving average in black, close is 100, and this red one is 30. And so what we've seen with the S&P is that, what has it been using as support? Well, it's been using this 30-day moving average, seems to have been acting as a support level. And then back here in, when was this? In November, right around Thanksgiving, it kind of broke through that and came down to the 100-day moving average, and then came right back up again. So, and this little arrow, what does it mean? It means that the S&P has closed below the 30-day moving average. Now, if you don't have that little arrow on your line and you'd like to add it, you just come here where you've got simple moving average, click on the sprocket, and this says show breakout signals. The default is no. You can just change that to yes, and then hit OK and apply, and you'll be all set. So, we hit a new all-time high in the market, just a few days ago on the 12th of January. And so when we look at this, this is just today moving below the 30-day moving average, and it certainly hasn't broken the 100. So is the uptrend intact? Go ahead and type that in. Is it still uptrending? Because a down day doesn't necessarily make a downtrend, and an up day doesn't necessarily make an uptrend. this is just one day in the context of a larger trend. And whether we're looking at the last 3 months or the last year, this index was up just shy of 20%. I think it was up 18% last year. So yeah, the uptrend is still intact. Now, if it came down to the 100 and broke the 100-day moving average, and then if it came up, so if this happens, if it continues to come down, and then it comes up and bonks its head on this 100-day moving average, and that's our 100-day moving average, and then continues to move down, then we would have a change in trend. Yeah, so Carmen, if you go to studies, if you're on the desktop and then click on that icon, you can change that. And if you're struggling, you can always call the trade desk. When I started, I had those boys and girls, I had those guys on speed dial. Or you can call and Schwab's customer service and they can help you out. But so far, if we look at the S&P, the trend is intact. Okay, so what about, so today, if we're looking at higher highs and higher, and higher lows, so somebody is saying, I thought you said the trend is higher highs and higher lows. Well, if we're looking at the overall trend, here was a low, higher low. This is still a higher low. This low was 67.20 and this low is 68.02. So this is still a higher low. Okay. And, we've had highs and we did have a period of consolidation here. Where we did have a lower high. And it created a bit of what we call a pennant pattern. And then it broke out to the upside. So even within an uptrend, it doesn't mean that every high is going to be higher. And yeah, but we're looking at, we're kind of standing back a little to look at this trend. Do you know what I mean? We aren't just looking at, well, here was a low here, and this is a lower low. And you're right about that. So if you're a very short-term trader, I mean, you can look at this however you like. Technical analysis is a bit, beauty is in the eye of the beholder. So is, analyzing charts. But there are some basics that are congruent. So when we look at the NASDAQ, and this was up, like if we want to see the last year, show price as a percentage. And then if I bring up a 1-year chart, we were up at the end of the year over 20%. And now, even now in the last 12 months, we're up 16%. And so again, this was using the 30-day moving average as a support level, came down. And now this is the third time it's kind of played kiss and tell with the 100-day moving average, but has it broken below? No. And when we look at an intermediate term trend, we've got a low, higher low, higher low. And again, are we setting up maybe a bit of a pennant pattern here? Could be, because now we've got some similar highs. And even within the context of an uptrend, does that happen on occasion? Sure. And again, we're down almost 2% today. And so, if you look at your portfolio on a daily basis and you have a lot of bullish positions, you own a lot of stocks, it could be a little worrisome. And I get that, but this is, and again, here we have, here's another index, the Dow, and just crossing the 30-day moving average today. But, it's done that how many times? Once, twice, kind of flirted with this, was under the 30-day moving average for almost a week and then kept on trucking, and then up, down, up, down. And yet the uptrend ultimately continued. Now, is that a guarantee that this uptrend is going to continue? No, but so far we don't have a confirmation of a break in trend. We have, and here, well, let me just change my drawing tool. Here there was some concern. We had a higher high here, but just barely, but low, higher low, higher low, higher low, higher low, higher low. High, higher high, you get the drift. It's still uptrending. So even though today, is a worrisome day for some, it's not necessarily a trigger that everything has to be sold. Okay, so let's look at some individual stocks. How about Goldman Sachs? I can do this. So Goldman Sachs, how would you describe this trend? I would say this is uptrending, right? And yet the last 2 days we've seen a pullback. And some might say like, ooh, I'm excited about this because it hit a new all-time high on Friday. And we've had a little pullback here. And this candle, this inverted hammer, is a sign, like this candle was, that this pullback may be complete. Now, from a technical perspective, we would say that this candle needs confirmation. So we need to see this trade above, like close above the high of this day for us to say that this uptrend is now continuing, if you're being conservative. And I have done a bunch of mini sessions that are within this playlist. I've also got a whole group of them nicely lined up in the trade management mini session playlist. And I can show you that in a few minutes. That just kind of goes over how some people look at trading candle patterns, or what those candle patterns might indicate. Let's look at American Express. So American Express, this one has been kind of moving. It's not been marching as straight up the hill as some other stocks have been, but we're seeing that this has been using not the 30-day moving average, which it's been weaving back and forth through, but this 100-day moving average as a support level. And where is it sitting right now? At that 100-day moving average. And so is this a break of trend? Not yet. Could it be? It could, but so far, like Chris and so many of the others have said, this is still uptrending. Okay, how about Mobileye, MBLY? How would you describe this? Well, and you can see here our 100-day moving average is smoother, than our 30-day, which is kind of moving more up and down. But what we've seen on this, it was at 20, it's now at 10. So this downtrend is continuing. So just because we're seeing an uptake day today doesn't mean that the trend has reversed. Okay. Now I had posted, I've got just such a great memory, but today it seems to be short. Sometimes we'll have something that's been going sideways. And I just posted one such example today. Let me see, why is it not showing up? Oh, Target. So when we look at a stock like this, and I drew some lines in here, really it for almost the last year, since the end of March, this has been in this big sideways range, right? And this pattern, and we'll talk more about these patterns, but this pattern is called a double bottom. And then it looks like it has now broken out and is coming back to retest. And so some might consider this an entry if in fact tomorrow or the next day we have a close above the high of this low day, which is today. And it recently had a price upgrade by an analyst from 112. Morgan Stanley raised their price target to 125, which is kind of up here. Okay, so some might say, well, I see this as a buy signal if, and there's an if on that, if it goes above today's high. And so if you wanted to place a conditional order, you could say, well, today's high is 110.66. So if it goes $1 above that, then I'd like to buy some shares. And if you wanted to put a target on that, then you might, just subtract this 86 from the 107, which is about $20, and you could put a target about $20 higher than this 107, so say 127. So if you wanted to put that in, how would you do that? And where might you put a stop? Well, you might say, hey, if I do place this trade, I'm seeing this 107, 43, this low today, as a support level. So I'm going to take that 107.43, today's low, and I'm going to bring my calculator up here. We're going to switch this to a calculator and say I'm going to put a stop at 107.43. I'm going to make it 3% lower so that I'm trying to define my risk. So our stop is going to be at 104.20. And I'm going to put this in our IRA account. So we're going to buy 100 shares, and we're going to put in a target on this of 127. And so to do that, we would come here and say we want to buy custom with an OCO bracket. So we want to put our target in at 127 and our stop in at 104.20. And then we want to make this, we don't want to get in yet. We only want to get in. So we're going to make this good till canceled, this good till canceled, and this good till canceled. And then we're going to put in a conditional order to say, we only want to buy if and only if this goes above, and what was it? I think it was 110, just a sec. Should have written that down. 110.66. So we're going to make that 111.66. So there's our trade. Only if this goes above 111.66. So if it trades above today's high, and you know, I just picked $1. You could make it 50 cents. You can make it whatever you want. My kind of rule of thumb is if it's over $100, I make it $1. Okay. So confirm and send. So we want to buy 100 shares of Target. If Target goes above today's high by $1, 111.66, and we want to sell when it gets to 127, or if it goes below 104. So we're risking about $7 for the share for the opportunity to make about $16 a share. Okay. And so we are going to put this in our stock with target group. And this is a target based on the range, the width of the range. So that if you're going back and looking at it later going like, how did I ever come up with that target? That's how you came up with it. So Barbara is asking, how did you come up with that target? Well, we just took this 86 and like 107, subtracted 86. And so this range here is about $20. The difference in price. It moved around, stayed within this range for, 8 or 9 months. And so we're saying if this breakout continues and this bounces, the expectation is that it might go up $20. So we just took 107 and we added $20 to it. That's how we got that target. Okay. Let's look at INTC. So, here's a stock that year to date is up 30%. But, has pulled back for a couple of days. And then today, this candle pattern is called a harami, in that the body of today's candle is totally inside the body of Friday's candle. And that's considered to be bullish. Now, we do have earnings coming up, and you might say, well, if it gaps up on earnings, I don't want to miss it. This is one where some people will use, a protective put, or what they call a married put, where they'll buy the stock and they'll buy a put just to protect themselves to the downside. Because what really frosts your petunias is if earnings comes and the stock gaps down and then rallies throughout the day, and it triggers your stop and you end up stopped out when you wouldn't have chosen to exit the position. So when you buy a put, then you're in the driver's seat and you can choose whether or not to exit. But, it's not something that, you're going to get nicked out on a wick, is what I call it. Okay, so let's look at Google. So this is another one where if you wanted to do, an example trade, you could do that. And so Google, does this kind of remind you of what's going on with the NASDAQ and the S&P? It's been very, very bullish, been moving up a series of higher highs, higher lows, hit a new all-time high last week on the 13th. And today it's pulling back. And we have this, the reason this candle looks like this is because it's bearish, because it's trading lower. It's down by 2.2%. It's trading lower than where it closed Friday, but it opened lower and it's trying to rally. And we call this an inverted hammer. And it's an inverted hammer happening at a support level. And so technically, some might say, well, I'm only going to place a trade if it trades above this tomorrow, if I have confirmation. And others, if you were trading more aggressively, might say, I want to place this trade now. And I'm going to buy 100 shares. And, if it doesn't go up right away, I'm okay with that. And I'm going to put in a swing target. If you were looking to generate income in the short term, you might say, I'm going to buy it here at 322. When it gets to 340, I'm going to sell it. Because this uptrend, even though we're seeing this pullback, this uptrend is still intact. Okay. Yeah, somebody's saying a number of these look like opportunities. And they can be. And sometimes when we have these short-term pullbacks, it does provide opportunity. And, so if we wanted to do this, and if we said, well, we have a $500,000 account, we don't want any one position to be more than 5% or, 25,000. Can we buy 100 shares? No. But does that mean we can't buy Google? No, we could just say, okay, I can do a $25,000 position. I'm going to divide that by 25,000 divided by 323. So we could buy 77 shares. And then where might we put our stop? Well, we might say it's been using this 30-day moving average as support. So I'm going to use that, 322, this number in red at the side is our 30-day moving average. So let's call it, okay, 323. So, and if I go 3% below that, 323 times 0.97. So we're going to put our stop at about $313.31. And we're going to put our target at 340. And so this is a swing trade using stock. And if we wanted a more aggressive entry, what some might consider more aggressive as opposed to conservative, we're going to do 77 shares. We're going to buy them right now. We're going to put our target at 340. And we're going to put our stop at 313.31. We're going to make these good till cancel. And this is also a stock trade with a target. And this might be a shorter term income generating trade. Now, some people might say, well, I'd like to add, so 3% is just an example. You could use 2. You could use 5 if you wanted to give it more room, but 3% is a general rule of thumb that usually if something goes more than 3% below a support level, it's considered to have broken that support level. And this is a swing target. That's how we came up with that target. So we're going to send that in and we'll just see how those work out. Now, I did want to show you on Trader Talks, especially if you're newer to this, what will first come up is whatever class is currently being taught. But if you come to playlists, and this is just kind of nice the way this is laid out. If you come to these mini sessions, now these are also within the Getting Started with Technical Analysis, but here we've grouped them all together. And so we've got 12 that are done in this little series. They all range in time from like 2 to 5 minutes. So, they're kind of technical analysis snacks, if you will. They're just bite-sized pieces. So you could do some binge learning if you like. So there is a survey in the chat. Scott has reposted it several times. And here's the deal with the survey. If you would click on that link, there's 2 questions. One is, I hated it, and 10 is I loved it, and then there's everything in between. And you have the ability to put comments in. So if there are things you'd like me to cover in future classes, if you like the pace, I promise if you fill it out that I'll read each and every comment, and so will the management team. If you hit the like button, it helps move this up in the YouTube algorithm so that more people will see this content. So we'd appreciate you giving it a like. And if you haven't already subscribed to the channel, there's a button in the bottom right-hand part of your screen, and you can click on that. And it will subscribe you to our YouTube channel. And of course, all of that is complimentary. You're not going to get any free for the first 30 days. It's all free. So guys, that's a wrap for today. Sharice is asking, can I show you an inexpensive, strong stock? I don't have one that comes to mind, but I'll look at that for next week, because next week we'll be talking about support and resistance. So come back next week and we'll have more to cover. So I want to thank the guys behind the scenes for helping bring this class to life. I want to thank each of you for showing up, and to Scott for being so great in the chat. Guys, have a really awesome day. Up next at the top of the hour is Swing Trading with Mike Fairborn. You'll want to stick around for that. Take care, everyone. Bye for now.